Looking for a high quality stock with momentum on its side? Like the idea of getting a good deal on a great business? Want to know about a stock that looks undervalued, just increased the dividend, and announced a huge buyback program? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing people all over the world with life-improving and life-saving drugs. World-class pharmaceutical companies basically print money. That's because they're providing necessary products to very willing buyers. Not just that though, the world is growing larger while it's also growing older. The customer base is growing and lasting longer. That bodes well for increasing profits and increasing dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of BristolMyers Squib Co., which appear to be trading at a significant discount today. BristolMyers Squib Co., stock ticker BMY, is a global biopharmaceutical company that is engaged in discovering, developing, and delivering a range of medicines to help people overcome serious diseases. Founded in 1887, BristolMyers Squib is now a $125 billion by market cap healthcare giant that employs 30,000 people. The company focuses on oncology, cardiovascular, and immunology treatments. 3 primary drugs together accounted for almost 70% of sales: Revlimid, Opdivo, and Eliquis. Eliquis is jointly developed and commercialized with Pfizer Inc., stock ticker PFE. Bristol-Myers Squibb has long been a major player in the pharma space, but they became much larger with the 2019 acquisition of Celgene Corporation for $74 billion. This acquisition added blockbuster cancer drug Revlimid to the sales mix. Revlimid produced more than $12 billion in sales in 2020, making it one of the top-selling drugs in the whole world. It's the crown jewel for the combined business. Global pharmaceutical companies are basically money machines, and there's no end in sight for the money printing. People are living longer than ever before. While longevity is wonderful, older human beings tend to incur health issues that require medical intervention, like therapeutics. And since people are also wealthier than ever before on average, they have the financial resources with which to acquire these medical interventions. Simultaneously, our global population continues to grow. It's possible that we hit 10 billion people by 2050. That's a lot of older, wealthier people needing medicine. If these long-term demographic tailwinds weren't already enough, global pharmaceutical companies are steadily developing more advanced medicines and charging more money for them. Ever more treatments sold to ever more people at ever higher prices. This bodes extremely well for growing profits and dividends for years to come. Already, the company has increased its dividend for 13 consecutive years. Now, the 10-year dividend growth rate of 3.5% isn't exactly my cup of tea. However, their most recent dividend increase, announced only days ago, was over 10%, and that follows up a 9% plus dividend increase last year, indicating a rapid acceleration in dividend growth. I welcome this development, and it's layered on top of a market-beating 3.6% yield. This yield, by the way, doesn't just beat the market, it's also 80 basis points higher than the stock's own 5-year average yield. With a payout ratio of only 28.9% based on midpoint adjusted earnings per share guidance for this fiscal year, there's plenty of room here for the dividend to go a lot higher. I like dividend growth stocks in what I refer to as the sweet spot. That's the yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. Clearly, this stock is in the sweetest part of that sweet spot. Looking at business growth, BristolMyers Squib increased its revenue from $21.2 billion in fiscal year 2011 to $42.5 billion in fiscal year 2020. That's a compound annual growth rate of 8%. This is impressive. However, a lot of this absolute growth is due to the big Celgene acquisition. BristolMyers Squib simply became much larger through acquisition. Keep in mind, BristolMyers Squib issued new equity shares to Celgene shareholders as part of the acquisition. The outstanding share count is substantially higher today than it was a decade ago. As such, relative profit growth on a per share basis should give us better insight into the true growth profile. Earnings per share increased from $2.16 to $6.44 adjusted over this period, which is a compound annual growth rate of 12.9%. That's actually even more impressive than the top line growth. Admittedly, I used adjusted earnings per share for fiscal year 2020. That's because the acquisition integration and one-time charges greatly skewed the GAAP earnings per share result for fiscal year 2020. Looking forward, CFRA is forecasting that BristolMyers Squib will compound its earnings per share at an annual rate of 10% over the next 3 years. This wouldn't be far off from what the company has produced over the last decade. CFRA cites a healthy pipeline and the strength of its marketed brands as key long-term tailwinds. Regarding the pipeline, there are more than 50 compounds in development. This healthy pipeline is a necessity at this point. Patents on Revlimid start to expire in 2022, with unrestricted competition slated to begin in 2026. Since Revlimid is the company's crown jewel, the upcoming patent cliff is a serious threat. Continued development of successful drugs through healthy R&D is absolutely critical to their long-term success. I view CFRA's near-term earnings per share growth forecast as sensible. To put it in perspective, BristolMyers Squib's own non-GAAP earnings per share guidance for fiscal year 2021 would imply 16.1% year-over-year growth at the midpoint. In addition, the company just announced a huge $15 billion buyback program. That's more than 10% of the company's market cap. With a justifiable expectation for 10% annual earnings per share growth in place, I see a high likelihood for similar annual dividend growth over the foreseeable future. And that's more than enough when you're also locking in a 3.6% yield. Moving over to the balance sheet, the financial position is satisfactory. While the company did take on heavy debt to partially fund the Celgene acquisition, they went into the acquisition with a phenomenal balance sheet. What happened is, the balance sheet basically dropped from an excellent level to a level that's just good. The long-term debt to equity ratio is 1.3. The interest coverage ratio is currently not applicable. That's due to skewed earnings before taxes for fiscal year 2020. On the other hand, their interest coverage ratio in fiscal year 2018, the last full year before the Celgene acquisition, was over 30. I believe that once we see an increased earnings base normalizing against higher interest expenses, the interest coverage ratio will be fine. Profitability is robust as it sits, but I suspect this will also look a lot better once things normalize. Over the last 5 years, the firm has averaged annual net margin of 7.8% and annual return on equity of 12.8%. Both numbers would be a lot higher if not for the skewing of GAAP numbers for fiscal year 2020. I happen to think that BristolMyers Squib is more investable now than it's ever been. The healthy pipeline, blockbuster drug lineup, big buyback, and recent acceleration of growth all point to a very bright future. And the company is protected by durable competitive advantages that include global economies of scale, R&D, IP, established sales relationships, and patents. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Revlimid's upcoming patent cliff is a material risk. Acquisition integration risk remains. Regarding this, there has to be a lot of growth from the Celgene acquisition in order to rationalize the equity dilution and weaker balance sheet. The increased debt load also increases the company's exposure to interest rates, and it limits future M&A opportunities. Any major changes to healthcare in the US, especially around drug pricing, would impact BristolMyers Squib. And while the branded drug portfolio is strong, the company remains concentrated around only a small handful of highly successful drugs. There is pressure on the pipeline to develop new blockbusters. These risks shouldn't be taken lightly, but I still think this company can be a great long-term investment. The current valuation only serves to make me more enthusiastic about it. The forward price earnings ratio is only 8.0 based on midpoint guidance for this fiscal year's adjusted earnings per share. That's ludicrously low for a business growing at a double-digit rate. There's also a severe disconnect in the cash flow multiple. The current price to cash flow ratio of 8.6 is well off of the stock's 5-year average price to cash flow ratio of 15.9, despite an acceleration in growth. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate is just a tad lower than what I ordinarily use in the pharmaceutical space. Compared to the company's long-term earnings per share growth rate, CFRA's near-term earnings per share growth projection and the last 2 dividend increases, it's very conservative, but I would argue that it's appropriate to be cautious. The large Celgene acquisition is still new and unproven, the balance sheet is now leveraged, and there's a looming patent cliff on the company's most important drug. It's certainly possible, if not likely, that the company will grow its dividend at a higher rate than I'm modeling, but I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $77.04. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates BristolMyers Squib as a 4-star stock with a fair value estimate of $68. CFRA rates BristolMyers Squib as a 3-star hold with a 12-month target price of $60. I ended up on the high end this time, but CFRA's number looks light to me. Averaging the 3 numbers out gives us a final valuation of $68.35, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. BristolMyers Squibb Co. is a high-quality biopharmaceutical company that looks more investable than ever before to me. A big buyback program, growth acceleration, a strong branded drug portfolio, and a healthy pipeline all bode well. With a market-beating 3.6% yield, more than 10 consecutive years of dividend increases, a recent 10% plus dividend raise, a low payout ratio, and the potential that shares are 15% undervalued, this high-quality dividend growth stock is a highly worthy long-term idea here. And now for a special news announcement. Lowe's Companies Inc., stock ticker LOW, just announced that they added $13 billion to their buyback authorization. Based on the current authorization remaining in the program, that brings their buyback firepower up to $20 billion, which is nearly 12% of the market cap. I highlighted Lowe's as a cheap dividend aristocrat to consider buying back in August when the stock was around $192. It's now over $250. With Lowe's buying back its own stock hand over fist, it could be headed a lot higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.